Hello and welcome to the World Built Environment Forum webinar series. And for those of you joining us from Greater China, Gong Hei Fa Choi, Gong Shi Fa Choi, I apologize for my pronunciation. My name is Sean Ellison and I'm a senior economist with the RICS. I'm based in Sydney, Australia. And today we're discussing the results of the most recent RICS Global Construction Monitor. Over the next hour, I'll take you through the results, talking about some of the current dynamics of the Asia Pacific and Middle East and Africa construction markets and how those markets are expected to play out throughout the course of 2021. I'll then be joined by a panel of experts who will take a deeper dive into some of the issues, and that sure promises to be a very fruitful conversation. So I'm very happy to be joined today by two fantastic panelists. So first, Luai Azam, FRICS, who is the Chief Operating Officer of MEA and Partners based in Dubai. Luai, how are you this morning?
Good morning, how are you? Thank you very much.
Good, thank you very much for joining. And Matthew Mackey, MRICS, who is the National Director of Cost and Commercial at Arcadis, based in Brisbane, Australia. Matthew, how are you?
I'm good, thank you. Thanks for having me.
Thank you very much for joining us, and thank you all for joining us this morning. So I'll add before we get into it that we always do welcome your active involvement. Do please submit questions to our panel as it really helps to bring the conversation to life. If you are new to these webinars, you should see that you can submit questions at any time using the question box on your screen. We will pick up as many as we can go through throughout the session. Okay, so getting into the presentation. So how I'll frame this, I'm going to give a sort of a brief overview of the results of our most recent RICS Global Construction Monitor. I'm sure most of you on this webinar have a pretty good understanding about what this is. So I'll just go over what the sort of product is before we sort of get into the data. So this is a quarterly sentiment survey that tracks changes in conditions in global construction markets. And it's really important to remember that these are changes in conditions. So we're looking at whether things are basically going up or down. We're looking at changes rather than levels. So the data itself can be displayed at regional, national, and subnational levels. And you'll see all of those sort of actually, you'll only see the regional and national levels in this presentation, but we do have subnational breakouts for most of the countries that we include in this data set. In the most recent quarter, we had more than 1,800 unique responses globally, which is a fairly robust sample size for us. I'm not going to get into too much detail on this next point, but how we weight the regional data sets is using the World Bank GDP PPP series. There's a number of reasons why we do that and why that's sort of the most relevant way to weight a data set like this. If you're really interested in having that conversation, maybe just email me separately and I'm happy to talk your ear off about that. But the one thing to remember when you're looking at the data set is that different regions have different weightings based on this series. So when you're looking at the global data series, for example, Asia Pacific has roughly a 42 or 43% weighting in that series. The Americas and Europe each have roughly 25%, and then sort of the remaining 10% is the Middle East and Africa. So you know, there is some weighting, and even within that sort of these regions, you know, or even globally, different countries have quite large weighting. So for example, because we're using PPP and not just nominal GDP, China and India have the first and third largest weightings in the global data set, with the US having the second largest weighting. So each of those sort of countries have between, you know, an 8 to 16% weighting globally. So again, a lot of the data that you'll see is displayed using a net balance approach. And, you know, there's an example of that on the screen. And that's really the preferred method for measuring sentiment. And something also to keep in mind, that the most recent responses were collected between the 10th of December and the 17th of January. The bulk of responses were collected early in January, the first 2 weeks. And that's just important to remember, because sometimes, you know, the immediate sort of what's going on right now can really have a major impact as to how respondents sort of respond to the survey. So especially when we look at sort of the expectation series, as we will get into in a moment. You know, if you think back to what was going on in the first couple of weeks of the year, that could really inform that. Okay, so moving into the survey itself. I'm going to start by giving sort of a very basic overview of the results, and then we'll get into these points in a bit more detail as we move through the presentation. So the one thing that the results really highlight, and that really any data that has been released over the past 12 months has really highlighted, is that the impact of the pandemic itself has really been highly uneven amongst sectors of the economy. And this is true for parts of the construction market. So we did actually a very similar webinar for our commercial property market, or our commercial property monitor last week. Some of you may have actually been on that one. But you know, there is a very stark difference between conditions, say, in the construction market, especially the residential and the infrastructure construction markets, versus the commercial property market, which is still, you know, fairly depressed. For the construction market globally, the construction activity index hit +3 in Q4, and that's off the low of -24 in Q2. So what that is indicative of is really a stabilization in global conditions. There was a fair amount of dispersion between countries, and we'll get into that a little bit more as we move forward. But interestingly, sort of the two regions that we'll be focusing more on today, APAC and the Middle East and Africa, one tends to be leading sort of the global results, which APAC registered a CIA of +8 in the fourth quarter, which was the largest sort of amongst the global regions, or the highest amongst the global regions. And the MEA was at -10 in Q4, which was actually the lowest when you look at sort of Europe and the Americas as well. But it should be said that this is, although this you know, this might have been the lowest in the most current quarter, it's still showing improvement from the low of -40 that it actually registered in the second quarter. One of the more interesting dynamics that we picked up was that the improvement from the second to third quarter was largely driven by China. This isn't really a surprise given the timing of sort of lockdowns being lifted and the genesis of the pandemic itself having impacted China first. China obviously being the first country to start recovering from this. The dynamics from this third to fourth quarter show that there was more of a broad-based improvement. And there have been some markets that do appear to sort of have caught up with China, and those are we're picking up that globally as well. But even despite this improvement, there still are a couple of constraints to activities. You know, a lack of demand globally is still very prevalent, as are tight financial conditions for development. And you know, especially since the second quarter, we're now really starting to pick up some of the impacts of the supply chain bottlenecks, which could become a sort of a major issue in 2021 and moving forward. I guess on the other side, the sort of upside of this, expectations are still very upbeat, and what we're looking at is a very robust pickup in aggregate activity, as well as overall headcounts in 2021, which is a big change from where we were sort of the middle of last year. Amongst the sectors of the construction market, residential and infrastructure appear to be the most resilient, whereas non-residential the outlook is much more subdued. A lot of that is likely due to a heightened level of uncertainty around the sort of future of commercial property and other non-residential property. One concern that remains is that construction costs really that appear to be driven by the cost of materials are expected to increase faster than tenders are over the next 12 months. And just something to remember as we go through the presentation that, you know, expectations in particular are really sensitive to things like policy, you know, whether the vaccine rollouts globally are happen sort of quicker than expected or hit a few more speed bumps than expected. And you know, various other factors present various risks to both the upside and downside of these. So expectations can be very sensitive to these as we move forward. There are a number of X factors, as you would say. Yep, so moving into the results, this first slide basically just shows you the evolution of the construction activity index over the past 3 quarters. You can see from Q2 to Q3, there was a very large improvement in Asia. You know, 40% of the Asia Pacific index is China. So a lot of that was actually driven by a very sharp improvement in China. And from the third to the fourth quarter, we saw that improvement a bit more broad-based. So especially in Europe and the Americas, there was a lot more sort of positive momentum that we picked up amongst those 2 regions. Next slide. Now you can see there is a fair amount of sort of dispersion by countries. A lot of countries are actually sort of proceeding into the, I guess, the green part of this spectrum, which is indicative of them being in a much more robust expansion. So there are still some areas where conditions remained a bit more depressed. So in parts of the Middle East, like the UAE and Oman, South Africa and Turkey, you know, feedback from these markets is a little bit more negative, as it is in parts of Southern Europe and in Malaysia in APAC. So there is still a fair degree of dispersion both amongst the regions, but also within each region. There are those that are doing stronger, or that are experiencing sort of a stronger uptick right now, and those that are still, you know, conditions are still fairly subdued. Next slide. If we could actually just skip ahead one more slide. Yeah, there we go. But even despite this, you can still see that almost universally there's been a fairly dramatic improvement from the second quarter of 2020, which is really where a lot of the most severe impacts of the pandemic were being picked up. So a lot of, you know, globally markets were very suppressed, if not depressed. And since then, you know, we've entered into a much more expansionary phase. If we could slowly or quickly go back to the previous slide. And a lot, but even still, a lot of the barriers to activity really remain in place. So in particular, financial conditions between you know, the second and the fourth quarter really haven't seen that dramatic of an improvement globally. You know, it's still a fairly major impediment to activity, getting access to finance. Some of the weak demand pressures have eased to a degree. This is probably largely due to some of the lockdowns being lifted in various parts of the world, but there is still sort of a lack of demand globally that we're picking up as an impediment. And meanwhile, if you look at some of the other factors that are cited as holding back activity, things like material costs, labor shortages, skill shortages, and a shortage of materials, these all sort of point to the increase in supply chain bottlenecks that is starting to come through the pipeline. Okay, next slide, please. There we go. And even despite the sort of overall pickup in a metric like the construction activity index, the current sort of market activity is still fairly muted in much of the world. So if you look at how total workloads have changed over the past 3 months, which is the x-axis on this chart, you can see that with very few exceptions, workloads were still either stable or declines. And in some places you can see in Sri Lanka, South Africa, Malaysia, the UAE, Turkey, and Portugal, the declines were fairly sharp that respondents reported. Some of the exceptions to this we're already starting to see a pickup in overall market activity. Australia, New Zealand, Saudi Arabia, Canada, and China, right? These are places where the data is indicative of more of a pickup in activity. And, depending on the market, this might be more of the residential sector, or this might be more of the infrastructural market. There is some sort of idiosyncrasies between the nature of each of the expansions in each of these markets. But the one major takeaway I think from this chart is that expectations are fairly upbeat. There are very few markets where activity is expected to decline over the next 12 months. In the lion's share of markets, the construction market is expected to see some level of expansion over the next 12 months. And that ranges from something that's very moderate in, say, a place like South Korea or Italy, to something that's much more robust, like what we're picking up from respondents in the Philippines. Next slide, please. And along with that has come these changed expectations about different metrics. One of the big ones is hiring. So hiring is expected to resume in a lot more markets in 2021, especially comparing it to the second quarter results. So again, the expected change in headcounts over the next 12 months from the second quarter, is on that x-axis, that horizontal axis. And the only countries that were really expected to hire in the second quarter or see an increase in headcount were China, Sri Lanka, and the Philippines, right? And then looking at the vertical axis, countries that are now expected to see an increase in headcounts for the construction market are most large markets globally, right? And you can see I've tried to highlight the averages for the Middle East and Africa and APAC and global in teal. But you can just see the lion's share of markets. Construction firms are expected to sort of start to expand their headcounts over the next 12 months. Next slide, please. And again, this slide gives an example of the weight that expectations are improving sentiment. What this basically shows is that current activity, which is those 3 bars to the left in each segment, hasn't really started to pick up, right? So the only place where we're really getting some sort of a positive impulse is in the infrastructure market in Asia Pacific, or the residential market in Europe for current workloads, so over the course of Q4. So those are the only 2 segments of the market that really we saw expand in the most recent quarter. If we move forward and look at the next 12 months, we're looking at expansions in varying degrees depending on the market, sort of across the board. The outlook for commercial property is significantly more muted than what it is for residential and the infrastructure segments of the market. But it is still in, with the exception of Europe, positive in some parts of the world, which is, the market is expected to see some degree of growth, if not sort of the same degree as other markets. Next slide, please. Oh, sorry, I think I'm ahead. Previous slide, please. Yeah, and this slide again, just, yeah, there we go. And this slide again just sort of hammers that home, where the current activity is much more muted, and we're looking at an expansion sort of over the next 12 months. Sorry, next slide. One of the interesting things that we picked up was there's obviously been a lot of talk about using infrastructure as a type of stimulus to the broader economy. A lot of governments have really started to front load projects that are shovel ready, and really started to prioritize some of these infrastructure projects in order to give broader economy a bit of a boost. So what we picked up globally is that there's really only two segments where that's been occurring, and that's in ICT, which is information communications technology, and the energy sectors. So depending on what region you're in, there might be a mix of other sort of projects and infrastructure that have really, or other segments of the infrastructure market that have been a bit stronger. For example, in Asia Pacific, we've seen a pickup across the board, and with the exception of agribusiness. And the only place we've seen a real pickup in agribusiness infrastructure projects has been the Americas. But this ICT and energy sort of pickup has been really very strong in the fourth quarter. Now moving on, I'm going to highlight a few points from a presentation that I mentioned I did last week on the results of the Commercial Property Monitor, because I think it's really relevant for the outlook for non-residential construction in particular. So part of the thing that I mentioned was really plaguing the sectors is the uncertainty around the outlook for non-residential construction, in particular commercial property. So if you look at where the market's at right now, we still have more than half of respondents to our surveys saying that the commercial market is in a bit of a downturn. And there's been a couple of major impacts from this pandemic on the commercial property market. One is it seemed to accelerate a lot of pre-pandemic trends. So sort of the rise of industrial properties and the importance of logistics, with the rise of e-commerce, as well as sort of this the symmetric effect, the negative effect that it's had on bricks and mortar retail. The second part of the pandemic that's really impacted commercial property is really the uncertainty around offices, and this is really unique to this pandemic, especially compared to other economic downturns that we've seen previously. So if you look at, say, the global financial crisis as an example, an office in 2007 was basically the same as what an office was in 2011. We didn't really interact with that space very differently. Obviously, pushing it forward 10 years, an office in 2023 may not look like an office in 2019, both from an investor's and an occupier's perspective. And I think because of that, there's been some difficulty in obviously determining then, how that affects, say, the valuation of these properties and how that affects some of the feasibility of some of these projects. And some of the data, moving on to the next slide, sort of points to that, right? Where this was a question we asked in the second quarter, how much we expect businesses to scale back their office footprint over the next few years. Excuse me. And globally, you know, the number was about 8%, right? But if we move over to the next slide, you can see that, you know, the range of values that got returned between countries is so broad, that, you know, in both between regions and within regions, that, you know, there's so much sort of idiosyncratic factors that are affecting this specific asset class, that make it really difficult to determine sort of how feasible, I guess, some of these non-residential projects really are. Moving on. So the last thing I'm going to finish on is just the outlook for tenders and costs. So sort of in line with the pickup in overall sentiment, tender price growth is expected to accelerate over the next 12 months versus where it was in Q2. So globally, we're looking at tender escalations of about 1.5%, versus, you know, close to zero the middle of last year. However, the next slide shows that these still aren't expected to keep pace with overall construction costs, which are expected to rise about 3% over the next 12 months. And as you can see by this slide, there is a fair amount of variance between regions, and a fair amount of variance sort of with what has ticked higher and ticked lower between regions. Obviously, cost escalations are expected to go much faster in Americas and Europe than they were sort of the beginning of, or the middle of last year, whereas the pace of cost escalation in the Middle East and Africa has actually eased somewhat, whereas Asia Pacific has more or less stayed fairly consistent. And if we were to break these out into, say, labor and materials costs, which are sort of the two sub-elements of costs that we track in this survey, overwhelmingly materials costs appear to be pushing this higher, and feedback that we've gotten from comments from survey participants really point to a lot of these supply chain bottlenecks pushing construction costs higher. So then finally, if we look at the difference between tenders and construction costs, you can see that, you know, everywhere tenders are expected to rise a bit at a slower rate than construction costs. Again, this varies in how this outlook varies. What this will probably mean is that financial conditions, at least in the immediate future, are likely to remain tight, especially in places like Europe, which construction costs are rising significantly faster than tenders. And then finally, excuse me, it does increase the risk of sort of persistent underbidding. And in the second quarter, when we asked about underbidding, you know, we had about just under half of global respondents reporting some degree of underbidding, with the average underbid that's bid below feasible cost being about 7%. So whether this persists or even ticks higher as the discrepancy between tender price increases and cost increases, that could present a bit of a risk as we move throughout the year, and that could actually obstruct this or slow the pace of the potential recovery. Okay, and with that, I am going to move on to our panel discussion. So as introduced in the introduction, I'm being joined by Luai Azam of RICS, Luai, could you just take a moment to maybe introduce yourself and say a few things about your business?
Sure. Thank you, Sean, for the insight. Very interesting presentation indeed. My name is Luai Azzam of RICS. I am the Chief Operating Officer of MEA and Partners. We are a chartered and regulated firm operating with offices in the Middle East and Gulf regions. We have been around for just over 40 years, providing cost management, quant surveying, project management, claims management services to our clients in this region. We are very proud to be associated with developing the first academic QS degree course, or let's say professional diploma course in Jordan. This was the dream of our founder because quant surveying was hardly known, or pretty much hardly known in this part of the world, and every effort that can be given to raise awareness of this important profession is definitely needed. So his dream was to establish a diploma initially to raise awareness of the profession. We have done that in Jordan with collaboration with the international university, and this is the third year the course has been running. So basically, as NEA, we operate with different types of clients, customers. We have private developers, public, government, banks, consultants, contractors. So we deal with the whole supply chain, basically. So that's just a little bit about NEA.
Thank you very much. Yeah. Thank you very much, Luai, and thank you again for joining us today. And we are also joined by Matthew Mackey from Arcadis. Matthew, if you'd just like to give a brief introduction about your business here in Australia.
Yeah, sure, no worries. So Arcadis is a leading design and engineering consultancy. We've got 28,000 people globally across 70 countries. In Australia, I'm the national director for our cost and commercial business, which is basically the quantity surveying function. And globally, still haven't quite worked this out yet. We are either the largest or certainly one of the largest QSs in the world, with 4,000 cost managers worldwide. But my particular remit is I've got responsibility for growing our cost and commercial business in Australia.
Thank you very much, Matthew. And again, thank you for joining us. And before I get into the questions to the panelists, I should just note that despite having an all-male panel today, RICS as an organization remains committed to diversity and inclusion. Okay, so getting into the bulk of the panel discussion, it might be useful if just to set the scene, if you could each give an example or sort of talk about how COVID has affected your business. Luai, it's obviously affected you very recently on a personal level. Perhaps you could begin the conversation.
Sean, unfortunately, I picked up the coronavirus about 10 days ago, and to be honest, you do not know what it feels until you've actually had it. So I can now feel with all the people and that has suffered. And anyhow, I'm just glad there's a vaccine now, and hopefully we can get over it soon. In terms of how it affected our business, obviously, first thing that comes to mind is disruption. The COVID happened so quickly that you really had to adapt to the unknown. There was a lot of uncertainty surrounding the COVID at the beginning. We weren't sure whether you're allowed to go to the office, what was the allowed capacities, the social distancing. So that is from a health and safety perspective. So at the beginning, it was a little bit disruptive. Do we go to the office? We do not go to the office. We have deliverables. We have timelines to meet. So that caused this disruption. So if I will break our kind of deliverables into a pre-contract and post-contract, let's say during design and during construction, what has happened is during design, many of the projects that were considered non-essential, like their hospitality projects, luxury projects, that they, at this moment in time, they didn't really need to go ahead. These were shelved. How that affected us, obviously, you had manpower in the office working on these different kind of developments. All of these stopped. So what do you do with the manpower? Okay, do you send them home? Do you reduce salaries? Do you send them on paid leaves? So there's a few options we considered with our head office staff. So we had to take a few of these actions. If we talk about the post-contract stage or during construction, the way it has hit us, basically, I would say 90% of our clients, they have demanded, not even requested, demanded between 30 to 50% reduction on our monthly invoice for a minimum period of 4 to 6 months. And that was, you either take it or you're off the project. This was a big challenge, obviously, that we had to, again, accommodate and try to absorb in this tough time. That, luckily, this forced reduction has now come to an end, and we obviously reinstated the staff salaries back to within the normal ranges, so there was not much reductions anymore. So this, in a nutshell, if I would describe how it impacted our services during both stages of the construction, of the, development.
Thank you very much, Loy. And on a personal note, we are glad to hear that you are feeling well enough to join us today.
Thank you, Sean.
Matthew, could you give some insight as to how the pandemic affected Arcadis's business, especially since you sit in Australia, a country that has dealt with the pandemic a little bit differently than some other countries in the West specifically.
Yeah, absolutely. I think from the perspective of other countries, Australia probably seemed pretty aggressive in terms of how they tackled it right from the start. That's obviously borne fruit now in terms of where we currently sit. How it's affected as a business, just like everybody else, right at the start of the year in Australia, there was a lot of uncertainty, particularly as lockdowns came in pretty much across the country. And that uncertainty has kind of remained for a good chunk of 2020. So Arcadis did what a lot of businesses did and had to, which was pretty much close their offices and get people to work from home. But what Arcadis has done pretty well is after that, make sure that people have stayed connected, and that's obviously through technology and things like Teams and Zoom, etc. And they've actually supported by providing equipment for us to work from home on. So whether that's a second screen or whether that's a task chair or a keyboard, they've actually provided that infrastructure to people so that nobody has to work from a laptop from their kitchen worktop anymore. So that's obviously been a big help. They've also Arcadis has also supported its staff quite well, unlike what was just explained for the Middle East, is that we've been fortunate enough where we haven't had to do any big layoffs or do any huge pay cuts and stuff. There's been a lot of people volunteering to take holidays but continue to work, and that's been from the senior leadership down through the business, which has obviously helped. And don't get me wrong, we have lost people along the way. I don't think there are very few businesses that have been immune from that. But Arcadis has done everything it possibly can do to make sure we haven't had to resort to that. And while uncertainty was certainly there probably towards the end of Q1 last year and into Q2, and projects started finding the way, and particularly projects that were on track, we've actually done reasonably well from last year. Some parts of the business have suffered more than others, depending on the markets they operate in, as was kind of alluded to in your slides earlier, Sean. But overall, we, as an overall business, the overall business has supported each business unit, and we've kind of come out the other side of that now. And while there are still challenges in the market, it's obviously not the same kind of challenges that are happening in the US and the UK at the moment in other parts of the world. So we're hoping, touch wood, that the vaccine comes out. We don't have any other big shutdowns and border closures like we've had, like we had towards the end of last year, and that the market continues to move forward. But yeah, overall, Australia's done pretty well, and Arcadis on the back of that have actually supported their people really, really well, and we've managed to continue moving with broadly the same team that we started last year with.
Thank you, Matthew. It's nice to hear a bit more of a positive spin on things on your end. I might stick with you then, move forward, and building off that, could you just describe where the construction market basically stood at the end of 2020, and how you expect this to change as we move through 2021?
Well, I mean, towards the end of 2020, I think it was about October, November time, there was a large federal budget announced, which provided a significant amount of, well, certainly an increased level of certainty in terms of infrastructure pipeline. And I think most of the individual states have kind of obviously not matched the same level, but have certainly contributed with their own state-based pipelines. And the one thing to bear in mind about Australia, and it's kind of a repeat of what you were covering in your slides, is that when you actually start looking at different regions and you delve down into the individual countries, you see a slightly different picture. It's like that in Australia. You can see one picture nationally, but then you delve down into each individual state, and it's again a different picture again, just because of the size of Australia as a population and a landmass. But yeah, there was a bit more certainty created the last year, end of last year. The challenge now for government is how those projects actually come to market and when they come to market. And we're actually now having the opposite discussion, which when all the discussion was about was the workload, was the secured pipeline, how can contractors, how can consultants maintain workforce and keep pushing forward when they don't know what food they can put on the table over the next 2 or 3 months. Now we've got potentially the opposite problem is that if all this infrastructure work happens, how are we actually going to deliver it all? Because there is only so much labour, there's only so many contractors who can deliver it, and so everyone keeps talking about the bow wave. And if all this project does happen over the next couple of years, like everyone is predicting, I suspect a lot of it will get pushed out. But if it does happen, then we're going to have the opposite problem of construction costs suddenly spiking in completely the other direction, because there won't be enough people to actually deliver it. Now, that could also be challenged as well and made and exacerbated by the very fact that if we continue to have state border closures, because every time there's a case in one part of the country, certain states, Queensland is one, WA more recently, they tend to shut the borders because they don't want people travelling and spreading it. So, which goes back to my comment before about how aggressive Australia's been in terms of tackling COVID-19. But if those state border closures continue, then that obviously has an impact in terms of labour force being able to move in between states to actually deliver work, and that again could exacerbate the problem and drive construction costs further north. So there's a few challenges in the near future. Overall, you'd probably say, well, they're the problems that we'd like to have, but yeah, there are challenges on the horizon for sure.
Thank you, Matthew. I might just stick with you for a second and follow up on that point you made about infrastructure. It sounds like this actually presents a bit of a risk sort of over the next 12 months. Is there a way to bridge this, or has there been sort of any solutions presented from an Australian perspective to help ease some of these constraints that you see potentially emerging on the horizon?
Well, there have been conversations with the government about prediction and understanding demand requirements versus capacity, and that's kind of research that's happening now. That kind of thing's been happening in Hong Kong. Arcadis have been engaged with some similar kind of research over in Hong Kong, and we're hoping that kind of research happens here as well, because it's great for politicians to get up and say we're going to announce all this infrastructure work and all this work's coming and it's going to keep the economy going. But if that is not actually supported by the industry in terms of their capacity and capability and skill set, then that's just going to create the opposite headline in a year's time, 2 years' time, of projects being over budget and beyond program. So it's about having that balance between the whole thing. So there's no one silver bullet. There are changes in technology, there's changes in approach, which have kind of been forced by the disruption of COVID-19. But there's no one thing that's driving those improvements. It's a lot of little things together. I just hope that the level of disruption that we've seen over the last 12 months that has caused a change, it has caused a change in several areas across the industry. I just hope that continues to occur, because it will create benefits in terms of cost. It will create benefits in terms of productivity. But my worry is that if we end up going back to business as usual, we'll go back to the industry that doesn't innovate, is slow to innovate, and costs continue to rise, and there's no productivity matching it.
No, absolutely, Matthew. As with everything, it seems like the devil's in the details, isn't it?
Absolutely.
No, thank you. Now, moving over to Luai, how does sort of, I guess, what Matthew presented compare to the current market conditions in the Middle East? And from your perspective, how do you expect things to change over the next 12 months?
Okay. What has happened here over the past 12 months is we've noticed lots of consolidation of big development arms. And on top of that, there has been a halt on launching of new projects by the big sort of government-backed developers. Now, whilst this is a negative, however, this could be seen as a positive by other smaller private developers who could see this as an opportunity for them now, so to be creative and to kind of have some their share in the market. The demand obviously has shifted tremendously towards residential developments, in particular villas, townhouses. That was basically only purely because of the impact of COVID and people not wanting to live in apartments anymore, where they can still afford to live in a townhouse and have their own space. So there is lately a lot of emphasis on building residential developments, communities of those sort of all kinds of ranges, from low costs to medium cost, and it seems it's moving. The challenges, in fact, that the COVID has brought with it is the viability of the contractors and the consultants. So, like Matthew said, if work comes, are these guys still available to do the work? This is a big challenge at the moment, because you might have a list of 10 suitable contractors, but when you go back to them to pre-qualify, half of them don't exist anymore. So this is a big challenge that we can see coming up in the next 12 months. Who is financially solid, that continue to take on projects, and who, is done. Now, if we this what I'm saying is obviously predominantly UAE based. However, if you look at other parts of the region, Saudi Arabia, for example, at the moment is now the place to be. This is where the developments are happening, all sorts, from hospitality to luxury to resorts, you name it. So I can see the Saudi market in the next 12 months being extremely busy, driving costs up, because there's going to be significant demand on contractors and consultants to deliver. and I can see prices going up there. Obviously, are there enough contractors to do the work? Are there enough consultants to do the work? We are yet to see. It reminds me a little bit of the UAE 15 years ago when the boom started happening. Obviously, now there is a different flavor. You've got the COVID situation, and as Matthew said, if closures stop from happening, border closures, yes, things will improve. But if we're back to border closures, again, we'll have problems in productivity and moving on.
No, thank you, Louis. And that's sort of what we're picking up as well within our survey results is Saudi Arabia was actually, if you look at just the construction activity index, it ranks second globally, and is very close to being sort of the top global market, which I think speaks to some of the strengths that you just brought up. Regarding the consolidation amongst firms that you just spoke about, do you think that could actually increase competition in the local market, given that you have more firms that are able to take advantage of economies of scale, or does that actually decrease and hamper competition in the local market?
Well, no, I think it will increase because these consolidated companies were all sort of building same products, right? So they are building villa compounds, they're building residential communities, they're pretty much building the same product in different parts of the town. Consolidating them into a company, they will focus their attention on building a particular product. And this will open the gates for other kind of give opportunity to other private developers to take their share of the market and build sort of their own unique products. I think it will open up competition instead of decrease it. Yes.
Absolutely. Thank you, Louis. And I know you've cited financial constraints and in some parts of the region, sort of weak demand. Are there any other impediments to activity that really stand out for you in the Middle East or in the UAE specifically?
Cash flow. Cash flow has been really tough. You know, even though the government has initiated several laws to ensure contractors are paid on time within the 30 days milestone, yet we are yet to see that. This is really a big concern because you've got the pandemic, cash is not coming in, you've got to pay salaries, you got to maintain your offices, etc. It's very challenging times.
No, absolutely. We can certainly appreciate that. Matthew, I know earlier you mentioned a couple impediments to the activity, especially given sort of the increase in infrastructure demand and sort of the limitations you face with just the number of people you can actually commit to projects. Is there anything else that you want to touch on in terms of things that are really obstacles in your market?
I think the obstacles that we're facing now are pretty much the obstacles we've been facing for the past few years. Something like COVID-19 that kind of comes out of left field and no one's expecting it. All it does really is exacerbate the same problems. So the problems that I was just talking about there in terms of cash flow and subcontractor cash flow, etc. They're still the same challenges that we have now, that we had pre-COVID. If anything, clients become, more difficult. It becomes more difficult for clients to pay because they're not getting the same returns. So that can drive down the supply chain. The same issue about skill shortages is still there. The availability of materials is obviously more pronounced now than it perhaps would have been without COVID. But I mean, I've seen a few pieces lately, particularly in the press, where people are saying that COVID has increased construction costs by anywhere between 1% and 3%. Now, I'm not a subscriber to that particularly, because I think market competitiveness and lack of pipeline has forced a lot of contractors to more readily participate in the race to the bottom. So I think the competitive pricing has actually reduced costs, not increased it. So I don't think I don't think anyone can really say that, you know, COVID has added X amount to a construction project, but undoubtedly it has had an effect, and it will continue to have an effect. So I think one of the other things we've got to consider is, as we move forward, and as the forecasts are now like COVID's going to be here for a while, or, you know, these kind of global pandemics may become more of a regular thing in our future, then maybe some of the strategies we've got in place in terms of social distancing on site, etc., and people checking in, checking out, and all that kind of process is going to become more the norm, which may have an impact on productivity, which may increase your construction costs further down the line as the market competitiveness and pipeline kind of equalizes. So there are a number of things that are going to continue to be an issue, and I think from an Australia perspective, the longer it takes for state borders to open more regularly, and in particular, the longer it takes for international borders to open, because that's how we deal, you know, in terms of having, you know, critical skills list as part of an immigration policy. That's how we offset a lot of our skill shortage issues, by actually creating opportunities for people to come from other parts of the world into Australia. As long as the international borders are closed, longer term, the skills shortage is just going to become more and more pronounced, particularly with the kind of uplift we're looking at in terms of infrastructure. And as the market starts to recover, people are going to be building more apartment buildings, universities are going to get back on track. Mission critical is obviously quite, you know, data centers is quite pronounced at the moment and will continue to be so in the future. All these sectors are going to start coming back. And as they all come back together, the question is going to be, who's going to be designing them, who's going to be engineering them, who's going to be building them, because we do have a finite resource of labour in Australia. And we would have lost people from the industry because of COVID, because of layoffs or whatever. And will those people come back? So there are a number of different issues. For me, the issues aren't really now. I think there are ways to get around the issues that are happening now, particularly when it comes to supply chain and material supply, etc. I think the biggest problems we're going to have is going to be over the next 12 months and beyond.
Oh, thank you, Matthew. And I am a bit cognizant of time, and I know that we have to wrap up shortly. But I might just finish with one extra question. And there's something you touched on a little bit earlier, Matt, when you mentioned whether firms will invest more in technology. Have you seen, since the start of COVID, has there been more of an appetite to invest in productivity enhancing technology in the construction sector? If yes, what does that mean for something like, you know, construction market employment? And if no, how do we sort of stimulate this type of investment, which is obviously very useful for productivity gains, in your opinion?
So,
oh, sorry, that was for Matthew.
oh, okay.
All right, sorry. Sorry, I thought you said it was for.
It's my Canadian accent that's throwing everyone off.
Yeah, it did throw me off a little bit. And sorry, I did only get part of the question. Would you mind just giving me an abridged version very, very quickly?
Sure. Just whether you've seen an increased appetite for firms to invest in productivity enhancing technology in the construction industry, and what that might mean for something like employment in the industry moving forward, maybe beyond the next 12 months.
Yeah, so I think some of that investment has already happened, and you know, and is happening. I think the very fact that a lot of people, particularly people who are office based, had to work from home, that increased a lot of that, some of that technology take up, particularly when it comes to, you know, things like Zoom and Teams, which doesn't sound like a big change, but for a lot of businesses it would have been. And that change that, we can actually operate quite sufficiently with people working from home rather than having to be in the office. So there's been a big change there. Unfortunately, that's just the lower end of the disruption scale. There's so much more we can do in between. And the problem with construction generally is that, you know, margins have generally always been tight. Margins are generally up for the bigger players. Is always about reporting to shareholders. So there's not like there's a huge amount of profit that's made that can be rearticulated back towards investment in technology and investment in innovation, which is why construction broadly has been so slow to adopt new ideas, new ways of thinking, new processes. COVID has probably exacerbated that yet further, is that nobody wants to go and do lots of investment into something new because they don't know what the future holds over the next 3 to 6 months. So I think that, I think I'm kind of arguing against myself there, but some of it is a case of that there has been some adoption of new ways of working. How far that goes and how far that continues to go remains to be seen. But I think, if anything, COVID has demonstrated that all these kind of investments in technology and looking at different ways to improve productivity and prediction and data capture, etc., it's a worthwhile investment, because COVID-19 has demonstrated to us if something like this happens again, we need to be equipped to try and deal with it better and not have that kind of sudden lull where everyone thought, what do we do? And everyone rushed to try and recover. We need to almost have a lot of that in place so that the recovery is a little bit easier and a little bit more predictable. Whether people will take the lessons, because people have got very, very short memories when it comes to pain, whether people will actually learn the lessons and do that investment, we'll see. But I'm very, very hopeful that people will.
Absolutely. Thank you, Matthew. It's something that we certainly don't want to be blindsided again. Luai, same question. I guess conditions are a little bit different where you sit, but have you seen some of this increased appetite to invest in tech in the sector? And if not, what do you think needs to be, or sort of how do you motivate that investment?
Okay. I think I pretty much agree with Matthew has said. Yes, in this part of the world, definitely there has been a big appetite with IT investment. Initially, which platform you go on to, is it Microsoft Teams, is it Skype, which works better? So there was this challenge at the beginning, and definitely companies had to act because they needed their jobs moving. They needed interaction with the consultants. Now, one thing I would like to highlight here, it's the culture. You can have all these wonderful IT infrastructure set up. However, at the end of the day, the nature of our industry would warrant a face-to-face interaction. You still need that element of, a human being interface. So I think while this COVID has expedited the IT investment in various companies, but only I believe this is only temporary, because we will still go back to the usual face-to-face meetings, presentations, and the like. This is just my opinion, to be honest, and how the culture works in this part of the world.
Thank you, Luis. So the new normal may not have completely made the old normal redundant, so to speak. So on that note, we have gone slightly over time, although still quite close to being on time for this one. I'd like to thank everyone who's attended, and especially both our panelists here today, Luai and Matthew. Thank you both very much. It was a wonderful conversation, and I know that all of the attendees most certainly appreciated your insights.
No problem. Thank you.
Thank you for having us.
And just a reminder that we will publish a recording and a written summary of this webinar online. Please do feel free to share those with your professional networks. Please take a few moments to let us know what you thought of today's session by completing the online poll, which will appear on your screens at the end of the webinar. The World Built Environment Forum Global Summit will be visiting Dubai as a part of Expo 2020 Dubai in January 2022. The week-long program will focus on the livable city, stable, smart, and healthy. To register your interest and to find further details on the program, please visit the website rics.org/WBEF. You can follow us on Twitter, Instagram, and LinkedIn, where you can receive news of upcoming webinars and catch up on any that you may have missed. And please also take a look at our new podcast series, have a listen, and tell you what you think. Thank you all again for joining us, and have a wonderful day.